Hi, accounting students. This is a short little video looking at some of the theory section in our cost accounting notes. There are a couple of topics here. The one deals with quality. If you've had a management class, for example, with Dr. Delpour, you probably would have covered total quality management and the idea of benchmarking and customer satisfaction. These kind of relate a little bit to just in time, which I'm going to scroll down to and talk about a bit. Um, this was an idea that really became very popular in the late 70s, early 80s. It was an idea actually that was developed by two US researchers, but at that stage, the US was not really open to changing the way that they did manufacturing. So these two researchers took the idea to Japan, where it was instituted and became very successful and led to the emergence at that stage of Japan becoming the second largest economy in the world. The quality of products in Japan surpassed the US's by many, many fold over. And they certainly became the benchmark in terms of what reliability and quality was. And we're not only talking about motor vehicles, we're talking about electronic products as well as other consumer staples. So what is the idea behind just in time? So the thinking was at that stage in the US that manufacturers just try to produce as much product as possible and then leave it to their marketing departments to try to sell those products, and sell them to perhaps an unwary and unsuspecting public. The just-in-time thinking turned this on the head, and they said, well, instead of just making stuff and trying to sell it, let's make what people want. And so instead of trying to push units through production, we would pull them through, but it would only be pulled through on demand. So if you're only making on demand, that meant that you have to have a very reliable supply chain. So you had to be able to get the raw materials when there was a demand for the product so you could make it immediately. You also had to improve the reliability and quality of your production process so that if you were making 10 units, all 10 units would come out and you could deliver them to the customers. Because if you had defective products, you'd have to go back and start the process again. So in many ways, just in time resulted in improved quality, and lent itself well to the idea of total quality management, which certainly the Japanese did take to a very high level. From an accounting point of view, obviously, if we make things only when they are needed to be sold, there are very few items sitting in inventory at any particular point in time. So we know that all the manufacturing costs ultimately go to cost of goods sold. And so why not just take them to cost of goods sold? And if by chance, at a midnight, at a year end or month end, there happen to be some items in production, we can take the costs out of cost of goods sold and allocate them back to those units. And that's known as backflush costing. Overall, just in time certainly has improved the production world. It's improved reliability, it's reduced waste, it's improved customer satisfaction, and it's obviously saved significant amounts of money. Activity-based costing we've spoken about before. It's just we are going to look at multiple ways of allocating overhead, not just on labor hours. Um, it helps you get a really good idea of what is driving your costs and results in better overhead allocation and more reliable or meaningful allocation of costs. So we know what things really cost us to make. The next thing we're going to talk about is the idea of the balanced scorecard. This was a big 90s idea. And it had come from dissatisfaction of looking at financial data in terms of how a company was doing. Financial data or financial analysis or ratios analysis tends to be backwards looking. It looks at a trend that has emerged in the past and assumes that that will be projected forward, which might work, if markets were very stable and there weren't new competitors and there weren't changing market conditions. However, that is maybe a scenario that could have applied and been valid in the 60s or 70s, but it didn't apply to the emergence of global trade in the 1990s. And so they were looking at other criteria that might be important for assessing how well a company is doing. And there were three additional criteria that were added. Internal business processes, learning and growth, and customers. Obviously, customers makes total sense. If your customers are not satisfied with your product or service, they're going to go away and your company's going to go out of business. So that's a no-brainer. Um, so we need to know what our customers think, which is why when you go to any supermarket or retailer, the chances are when they give you your receipt, they'll say, yeah, at the bottom, there's a little survey, fill it in, win some points, win some money. They really want to know what you think. It's very important to them. Then the next one will be learning and growth. And this is very true of our modern world. If you're not growing and you're not learning, you're going backwards. And so we need benchmarks and criteria that we can assess how well a company is learning and growing. It's actually very interesting that one of the sort of criteria that they use, they call it a proxy, is they look at employee satisfaction. And it turns out that employees are happier when they're working in an environment where they see growth, they see forward movement, and they're less likely to be dissatisfied, they're less likely to stay away from work, which kind of correlates to the idea that people do want to do a good job in their work. And the final one is internal business processes. We set up systems and procedures so that the processes work well and people must comply with those procedures. If they don't, things can go wrong and they can go badly wrong, which can cost the company a lot of money and even put it out of business. So the balanced scorecard is a much more robust way of looking at a company. And except for the financial ratios, the other ratios are very much forward looking and are better predictors of how we're likely to do in the future. Our final theory section we're going to look at is performance evaluation. Embedded in this is the idea that you should never hold somebody accountable for something they do not have control over. If you try to hold somebody responsible for something they have no control over, they're going to be incredibly dissatisfied and are likely to leave your company. So when deciding how to evaluate a manager of a division or branch, what do they have control over? Well, if you give them a budget of costs, that's all they really have control over. So that should be evaluated as a cost center. If they have access to marketing and control how much potentially revenue could come in, if they've got control over revenue and costs, we can call them a profit center. And then finally, if they have the ability to buy new assets, close sections down, change the products that we sell, basically have a fairly wide-ranging control, we would call this an investment center because they have control over revenue and costs, therefore profit, as well as the investment decisions. Finally, when we're looking at an investment center, it would make sense that we should look at judging the managers on the return on investment, which makes sense. And this has traditionally been the way that many managers were evaluated. However, the problem with return on investment is it motivates managers to pick projects that have a very high return on investment as they get a bigger bonus, which means they could abandon or maybe skip opportunities to generate a return on investment that is lower than what they could get, but is still higher than what the investors want. This would be defeating the objectives of the investors. The investors want a specific return on investment, and anything above that would be good for them. So that gives us the idea of what we call residual income. In residual income, we take the total asset base and we multiply it by the required rate of return. We then, that number would be the income that we want. We subtract that from the actual income that is being generated by that division. And as long as we're generating more income than is required for the minimum rate of return on the asset value, we're generating positive residual income. So residual income is a superior method of assessing an investment section compared to just return on investment. That's the end of our little mini theory section.